So maybe a little bit about me and the company that I work for, and then we'll get into why I disagree with the previous speakers. Stuart, I think you and I could have a good argument over a beer. I do think pensions can save the world, and I'll put the case forward for why I think that is the case. As I said, my name's Kaisie. I am a chartered financial activist. So I have worked in the finance sector since 1999, and along the way I've realized the importance of money. It does make the world go round, and it helps create the world around us. And if we don't like the way the world is around us, then we need money to do something different. So I've spent the last 10 years going into organizations and helping them understand that climate change is a thing. And yes, that's where the conversations were back at the beginning. Climate change is a thing, and they need to think about it. And importantly, they need to do something about it. The first maybe 8 of those years were particularly difficult. And often I would be in a room with 3 people and none of them wanted to listen to me. But in the run up to COP26, I'm very pleased to say that the rooms were packed and lots of people were listening. And there has been a huge shift, particularly within financial services, in terms of understanding that finance has a role to play. And we saw that at COP26 with the announcement of, and I'm going to get the acronym wrong, it's called GFANZ, but it's the Glasgow Financial Alliance for Net Zero, and it now has trillions associated with it, which means a whole bunch of fund managers, like the people that we've just heard from, have signed up to make sure that they're directing capital towards enabling the transition to a low carbon economy, net zero economy by 2050. But a lot of them have signed up and now they're thinking, oh dear, how am I going to do that? And how are we going to do it in the context of a world that maybe doesn't want to transition if policy doesn't do anything? So I think what I'm going to do is, as the guys were talking, I was just kind of fiddling about with my slides, because I think there's a couple of different things I'd like to share with you. And then I'd really like to get into the Q&A, because I think there's loads of questions that you guys will have that will lead to a really rich conversation. So now this is where I have to do technical stuff and talk. Let's see how this goes. Oh, it's also worth me saying I work at Royal London. So I go into financial institutions, help them understand climate change. I've worked with Aegon, Scottish Widows, and I'm now at Royal London. I've been with them just over a year and a half. So I am going to focus a little bit more on what I've done there. And they are mutual, so they're slightly different in that they don't have shareholders, so we don't suffer from that shareholder problem. And we also look after around £124 billion in assets. So that's quite a substantial amount of money that we need to look after on behalf of millions of customers. That maybe just gives you the context. Now, there's a little green button, share screen. I can do this. Aberdeen Cafe PowerPoint. Here we go. Share that. Oh no, there's another share button.
It's coming.
Coming. I'm on the wrong slide to start. Here we go.
Perfect.
Right, now the problem with sharing full screen is I have no idea which slide is going to come next, because I've been faffing about with them in the background. So if I pause for a minute to gather my thoughts, you'll know why. Okay. So lots of these slides were based on a discussion document that I put in front of our group executive when I first arrived at Royal London, to help them understand how do we as a financial institution help our customers move fairly to a sustainable world. And one of the big things for Royal London, and for all of us really, is trying to remember that humanity doesn't exist in decades, right? We exist in centuries and millennia. And so for Royal London, what I really wanted them to do was understand that their company had been around since the 1800s, and they had been stewards of that company for 150 years. So how are they going to be stewards of that company and the investments for the next 150 years? And what kind of decisions are they going to take today to shape their grandchildren's future? And really kind of putting that onus on the executive to take into account that actually they're the directors of these companies and their decisions really matter. And importantly, the decisions that we take today are going to shape the century to come. So on the left-hand side of this slide, what you'll see is the trajectory of carbon emissions. We're currently up and beyond 40 gigatons, and we need to get to net zero by 2050. What that means is we need to cut carbon emissions by more than 7% every year, year on year. Now, to put that into context, carbon emissions reduced between 5 and 10% during COVID because the entire world stopped. We need to see that kind of emissions reduction, not just 1 year, but every year, year on year until 2050. That is the kind of societal change that most of us cannot get our head around. And when we look at what the chief risk officers of all the big companies are saying at the moment, so they produce a chief risk officer report, and they put on the probability of us achieving the Paris Agreement goals. You'll see on the right-hand side, we have less than a 5% chance on the current trajectory of staying below 1.5 degrees. This has also been compounded by the recent IPCC report, which was announced last year, which talked about the fact that the window has closed for keeping warming below 1.5 degrees. And really what we need to be doing now is focusing on the activity that will drive action in the next decade to limit warming to below 2 degrees. Okay, so that's all the scary stuff, right? We've done that bit. And I'm assuming because this is the Aberdeen Climate Cafe, you're all up to speed on the climate science, and I'm not really telling you anything new. You're probably saying, get on with it and tell me about what it means for the investment sector. So why is the investment sector important? Because there's loads of money there. And all of that money that is saved by you as households, which is saved into your pension or put into the bank, rinses through the capital markets and then gets invested. And it gets invested in the companies and the projects that create the world around us. So it's not, can pensions save the world? Pensions create the world. And what I mean by that is if you look at all of the money in the investment market, nearly 80% of it is institutional investors. And of that, nearly 50% is pension funds. So there is a huge swathe of pension money that is in that market that is currently creating the world around us. And so it's really important that we're putting our money to good use. So one of the kind of ways that I explain pensions and investment is if you were to go to Starbucks or whichever kind of coffee chain you like to go to, you don't buy a cup, right? You buy coffee. It just happens to come in a cup. Ideally, you take your own cup and then they put the coffee in that. It's the same with pensions, right? You're not really buying a pension. A pension is the cup. What's really happening is your money is being invested. And what you're really buying is an investment in companies and projects. So it's really important to understand, as some of the other speakers have said, where is your money going? Because it doesn't just sit there idly in the cup, it gets invested. The first speaker talked a little bit about the difference between defined benefit. So that is the pension where your employer would just pay money out to you and you don't have much control, and defined contribution, which is the auto-enrollment pension. And you can see from these numbers, there's a huge amount of money that is still in defined benefit pensions, but that is shifting rapidly. Those are in decline and defined contributions are on the rise. But you can see, again, we're talking trillions of pounds, not hundreds of millions. So what is it we're trying to do here as investors? There's been a lot of discussion about the divestment movement, and there's been a lot of debate in different financial institutions about how we go about achieving net zero. We've all signed up to this initiative. Now, what you could do is just eject the big carbon emitters from your portfolio, but how does that help? That doesn't change anything in the real world. So as an individual, totally it makes sense. Myself, I invest in a sustainable fund because that's aligned to my sustainable preferences. But actually, as an institutional investor looking after 124 billion, is that the right thing to do? Do we need to just divest, or do we need to engage with the companies that we invest in to help them change? And this is one of the live debates at the moment. So what have we done as Royal London? This is very similar to lots of other organisations, so I'm not going to spend too much time on the top two boxes. What I do want to do is talk about the last box at the bottom. This is something a little bit unique. So lots of asset owners, which is pension companies, and asset managers, that's like Brooks Macdonald, the people that look after the money and invest it on behalf of pension customers, have committed to net zero by 2050. And what that means, they've basically said that they're going to use two different levers. And I think David covered this off really well. One is kind of how do you help companies decarbonize through your stewardship and engagement activities or through kicking them out of your portfolios? And two, how do you get money invested in climate solutions? So some of the impact investments he talked about. But what we're doing as Royal London, because we have so much money invested with these companies, we're working with a cohort of other institutional investors to really hold these companies to account. And we're engaging with these companies on something called a just transition. And I want to spend some time on that because I think it's really important for Aberdeen in particular. And the reason I think it's important for Aberdeen is, let's kind of just play through what happens if we eject, and I'll maybe share, maybe the next slide has the data on it, and then you can see why it's important. Yeah, okay, I'm just going to move, I can see everybody's head, I'm going to move you over here so I can see my numbers. So when we looked at where is our money invested, oh, you've all gone down the bottom, we found that and this is one of the questions that the board asked me, was how on earth are we going to cut our carbon footprint in half by 2030? How is that possible? Tell me how that's possible before we sign up to this net zero commitment. Well, when we looked at our holdings, and to be honest, if you're invested in a UK pension and if you're in the default fund, these are probably your top 10 risky companies as well, because it's skewed towards the UK market. We can see that over 50% of our carbon emissions come from 10 companies. And we could just divest from those and reduce our carbon footprint immediately. But that's not really going to help the world transition. So what we've said we will do is engage with these companies. And we started engaging with SSE, but if we're thinking about the Aberdeen experience, for example, if you had a whole bunch of big institutional investors suddenly divest from Shell and BP, much like Kodak, the company might go bust. And if the company goes bust, then the employees lose their jobs, and all of the companies that service those employees, all the supply chain companies also go bust. Now, what we don't want to do is create the kind of social friction and economic and societal losses that we experienced when the coal mines were shut. That was a badly managed energy transition. What we need to be able to do is have a very gradual, managed, careful, planned, conscious and aware energy transition, so that we look after the people and the communities who are going to be affected by this transition away from really high fossil fuel, carbon intensive industries into lower carbon intensive activities. So what we're doing is engaging with these companies, plus the companies in the utility sector in the UK, to say we want to see not just your plan for getting to net zero, but we want to see what's called a just transition plan. Now, this is outlined in the Paris Agreement, that the transition to net zero should be just, fair and equitable. And so what we're asking them to do is to outline how they will ramp down their high carbon activities, how they will retrain their staff, how they will assess the impact that they will have on local communities, and how they will manage those impacts. And I think it's a really important part of this narrative that the transition will not be easy, but we need to help manage the social costs of this transition in a way that makes it palatable for society and takes people with us, and doesn't, just decimate certain areas of our country. Move on from here. So as an outcome of this, some of the big things that we decided, and this comes back to some of the conversations that we heard at the start around, financial planners having conversations with customers, about investment managers thinking about how they integrate ESG. We really fundamentally went back to the beginning on our investment beliefs. And Royal London as a house used to believe that the best way to get access to market returns was to invest passively. And this year we've moved £25 billion away from passive management. So all of our funds that were managed passively have now moved away from passive management. Now, what passive management means is that you invest in every company according to its size. But what we believe is that actually the markets are not pricing climate risks correctly. And so we need to take action to shift the weight of our portfolios towards those companies that are putting in place just transition plans, and away from those companies that are not doing so. So if I were to rerun the table that I put on the screen, ExxonMobil Group is no longer in my top 10 because we have reduced our holding in Exxon because there are better ways to get exposure to that sector, and companies who have much better plans in place than Exxon do. A couple of other things. So it's not all just about risk. There will be some fantastic investment opportunities. we need to spend lots of money in order to build a new world. And that's one of the big things that investment managers are really struggling with. So there's lots of small projects on the ground, and there's lots of big buckets of money, but trying to fit the big bucket into the small project doesn't necessarily work. So there's a whole bunch of people interested in how do we solve the capital allocation conundrum between the owners of capital and where that capital is needed. So you've got people like the Scottish Government, who yesterday announced the Scottish Government Task Force on Green and Sustainable Finance, and one of their big deliverables is to create a bridge between where capital is needed, focused on place, and the owners of capital, such as pension funds. We also have, we had a meeting yesterday with Andy Haldane, who is, I can't remember his title, but he's been appointed Minister of Levelling Up by the Cabinet, and he's asking the very same questions. How do we get money from where it's currently invested in Shell and BP, out of Shell and BP and into the projects that are going to build a sustainable future? And that's the kinds of questions that I'm thinking about as we look after the 124 billion of assets that we manage on behalf of our customers. And just a final thought to leave you with, and this does link back to David's, what is the purpose of money, right? And shareholder capitalism and stakeholder capitalism. One of the reasons I came back to Edinburgh, I was quite safely ensconced in Australia watching the global financial crash from afar. And I just was rereading Adam Smith, a wonderful Scottish Enlightenment thinker, and thinking that he had been woefully misinterpreted. So Adam Smith never meant for the free hand of the market to trample all over society. And so as part of our work at COP26, we published an essay series where we engaged leading economists from around the world to revisit the wealth of nations through a climate lens. Nicola Sturgeon provided the foreword and I did the epilogue. I think that says in importance where I come at the back of the book. But I revisited the theory of moral sentiments. And really Adam Smith's work is in two parts. You're not supposed to read The Wealth of Nations alone. Adam Smith did not say we are all inherently selfish. What he did say is that markets are meant to serve a social purpose. And that is one of the key things that we need to remember, that finance can lose its social license to operate if it doesn't serve society. And that's one of the biggest things of being at a mutual, and it's certainly the message that I take to all financial institutions, is remember the reason you're here. The reason you're fundamentally here is that pension savers give you their money and they ask you to move it through time and look after it and give it back to them. And we're now at a point in history where it doesn't matter if you've got a pension pot of 10 trillion pounds if the world is on fire. So suddenly the type of world that we create with that pension money is just as important as the returns people get from their pension savings. And that is the thought I will leave you with, alongside the thought that I do believe that we can use pensions as a force for good to invest in creating a future that is worth living in. Now, I have to figure out how to stop sharing.
Kaisie, thanks very much. Thanks very much, David and Stuart as well, for 3 great talks. Sort of for me,